Hey everyone, welcome back to Corporate Decoder, the show where we dive deep into the world of corporate filings. Today we are decoding Prosperity Bankshares 10K, their annual report for 2024. Get ready for a wild ride. It's going to be prosperous for some, but maybe not for everyone. I'm just kidding, but get ready for this report. We're going to decode a lot. Prosperity Bankshares is basically a Texas-sized bank. They're not just some local corner store, they've got almost 300 branches scattered across Texas and even into Oklahoma. They're bringing in the big bucks through loans, customer fees, and smart investments. It's a competitive landscape, but with a twist of community banking. That's Prosperity's game. Part of their story is how they're growing, not just organically, but through acquisitions, too. In 2024, they finalized a merger with Lone Star State Bankshares, adding 5 more branches to their map out in West Texas. Think Lubbock and Midland, and it's bringing in over $1 billion in assets. Now that's how you make a statement. Diving a bit deeper, we find that Prosperity Bank isn't just about the money. They also care about their employees, or associates, as they call them. As of the end of 2024, they have almost 4,000 employees. The company also states that 50% of their workforce, from senior officers to tellers, is minority and 75% female. They're clearly proud of this diversity, and it's a big part of their brand. But as with every bank, there's a whole regulatory world to navigate. They're constantly being watched by the Federal Reserve, the FDIC, and even the Consumer Financial Protection Bureau. That's a lot of oversight. This report is chock full of legal jargon about capital requirements, permissible activities, and what happens if they don't play by the rules. These regulations are meant to protect us, the depositors, and the financial system. However, it can create limitations on their ability to do business, and it definitely affects their bottom line. They also expect the Trump administration will seek to implement a regulatory reform agenda that is significantly different than that of the Biden administration, impacting the rulemaking, supervision, examination, and enforcement priorities of the federal banking agencies. The report then goes on to the risk factors, or as I like to call it, the things that keep CEOs up at night. One of the biggest, interest rate risk. Prosperity's income is all about the difference between what they earn on loans and what they pay out on deposits. With rates constantly changing, managing that gap is key. Another risk, credit quality. They need to make sure the people borrowing money can actually pay it back. If the economy slows down or if oil prices crash again, their borrowers might have trouble, especially those smaller businesses that are less able to withstand difficult economic conditions. On that note, Prosperity admits to having a large number of oil and gas companies in the company's market areas. That makes them particularly sensitive to the price of oil and natural gas, which can have negative impacts on the U.S. economy, in particular, the economies of energy-dominant states such as Texas. Now let's get to the good stuff, the financials. Looking at their business strategy, Prosperity Bankshares' main objective is to increase deposits and loans through internal growth and acquisitions while maximizing profitability. To achieve this objective, the company has employed the following strategic goals. Continue community banking emphasis. The company is going to file its proxy statement, which involves certain business combinations, and how to evaluate these opportunities that would strategically expand the company's geographic footprint and enhance the company's market presence. So how did they actually do? Well, the aggregate market value of common stock held by non-affiliates was $5.58 billion. At December 31, 2024, total loans were $22.15 billion, an increase of $968.7 million, or 4.6% compared with $21.18 billion at December 31, 2023. Non-performing assets were 0.37% of total loans and other real estate at December 31, 2024. In 2020, the joint federal bank regulatory agencies issued an interim final rule that allowed banking organizations that implemented ASU 2016-13 to mitigate the effects of the CECL accounting standard in their regulatory capital for 2 years. The company's earnings are significantly dependent on its net interest income, which can be significantly impacted by overall market rates, a decrease in yield on variable loans and on new loans, and reduces its net interest income. The company is also subject to losses resulting from fraudulent and negligent acts from loan applicants, correspondents, or other third parties. The company believes it has underwriting and operational controls in place to prevent or detect such fraud, but these controls may not be effective in detecting fraud, and the company could experience fraud losses. Another significant risk is cybersecurity. Data privacy laws also continue to evolve, with states increasingly proposing or enacting legislation that relates to data privacy and data protection. In October 2022, the SEC adopted a final rule directing national securities exchanges and associations, including the NYSE, to implement listing standards that require listed companies to adopt policies mandating the recovery or clawback of excess incentive-based compensation earned by a current or former executive officer. The company adopted a compensation recovery policy pursuant to the NYSE listing standards on November 13, 2023, directing to recover excess compensation earned during the 3 fiscal years preceding the date the company prepares an accounting restatement. Capital adequacy requirements serve to limit the amount of dividends that may be paid by the bank. Under federal law, the bank cannot pay a dividend if, after paying the dividend, the bank will be undercapitalized. The FDIC may declare a dividend payment to be unsafe and unsound even though the bank would continue to meet its capital requirements after the dividend. In October 2024, the CFPB issued a final rule that requires a provider of payment accounts or products, such as a bank, to make data available to consumers free upon request regarding the products or services they obtain from the provider. The company adopted the option provided by the interim final rule, which delayed the effects of CECL on its regulatory capital through 2021, after which the effects were phased in over a 3-year period from January 1, 2022 through December 31, 2024. They also have to make sure their internal controls are solid and up to SEC standards and have it attested by a registered public accounting firm. And they need to be ready to claw back executive pay if there are any accounting restatements. The Federal Reserve Board issued a proposal under which the maximum permissible interchange fee for an electronic debit transaction would be the sum of 14.4 cents per transaction and 4 basis points multiplied by the value of the transaction. Investors and shareholder advocates continued to place emphasis on how corporations address environmental, social, and governance (ESG) issues in their business strategy when making investment decisions. Under this rule, banking organizations that are SEC registrants must generally disclose information about a material cybersecurity incident within 4 business days of determining it is material, with periodic updates as to the status of the incident in subsequent filings as necessary. The aggregate market value of the shares of common stock held by non-affiliates as of June 30, 2024 was approximately $5.58 billion. So, what's the big picture here? Well, Prosperity Bankshares is walking a tightrope. They're trying to grow by acquiring Lone Star State Bank shares, but they're also dealing with regulations, interest rate hikes, fraud risks, and the always looming threat of a cyber attack. Their regulatory compliance may be at risk given they are being watched closely. I think the key takeaway is whether they can keep expanding while maintaining their community bank identity and keeping costs down. The numbers will tell all. Also, it's worth noting that all of the company's securities must be sold to be considered well capitalized. So, for the average investor, the key takeaway is whether the company is financially healthy to keep paying its dividends in the future. There's a lot to keep an eye on, but I'd rate them as a cautiously stable hold, but we'll want to see if management can show some great results in this coming year. Thanks for watching. If you enjoyed this corporate decoder report, please subscribe, like, and comment. It really helps me out, and I'll see you next time.